Have you ever felt that sinking sensation when you realize the loan that was supposed to help you get ahead has somehow pulled you further behind? You know that specific moment. Maybe it's 3 a.m. and you're staring at the ceiling, doing mental math that never seems to add up. The transmission just died, or a tooth cracked, or the rent is due, and your bank account is sitting in single digits. That suffocating tightness in your chest when you realize you're not just broke, you're trapped. You probably felt intense shame. You looked at that payment schedule where you've paid thousands but still owe nearly what you borrowed, and you thought, I'm bad with money. I should have read the fine print. I made bad decisions. That shame is heavy. It makes you hide the letters, avoid the calls, stop asking for help. But what if I told you that shame was manufactured? What if your confusion, your growing debt, and your sense of personal failure weren't accidents, but the intended outcome of a system engineered exactly this way? What if the loan that seemed like a lifeline was actually a mathematically precise trap, and your inability to escape it wasn't a personal failing, but a structural success story, just not for you? My name is Pig, and I spend way too much time studying how systems of power actually operate, the hidden mechanisms that transfer wealth from many to few, the psychological techniques that make exploitation feel voluntary, and the legal frameworks that make it all seem normal. I dig into court documents, SEC filings, regulatory failures, and the mathematical structures that prove these aren't accidents, but carefully engineered extraction mechanisms. If you're tired of being told that your financial struggles are just about bad choices or lack of discipline, and you want to understand the real game being played behind the scenes of financial inclusion, you're in the right place. Here, we don't do comforting myths about mutual benefit. We do uncomfortable truths backed by documents, data, and follow the money analysis. If you want to decode how the modern debt machine was built, who profits from it, and how to protect yourself and your community, make sure to hit that subscribe button. Because today, we're going to expose one of the most sophisticated wealth extraction systems ever created. Here's what they tell you about lending. It's a mutually beneficial exchange where someone with capital lends it to someone who needs it, charging interest to cover risk and time value. The borrower gets access to funds for investments, emergencies, or consumption smoothing. The lender gets compensated for risk. Everyone wins. Economists will tell you this is efficient capital allocation, the foundation of modern capitalism. On paper, lending exists to expand economic opportunity, help people invest in education, start businesses, buy homes, and weather temporary setbacks. The textbook explanation emphasizes informed consent. Borrowers understand terms, calculate costs versus benefits, and make rational decisions. The official purpose of high-interest lending is framed as financial inclusion, serving the unbanked and underbanked abandoned by traditional institutions. Payday lenders, title loan operators, and buy now, pay later apps are marketed as heroes providing vital services to credit deserts. The high rates? That's just risk-based pricing for borrowers who might default. Regulators exist to ensure transparency and prevent abuse. Truth in lending laws require clear disclosure. Usury laws cap interest rates. Consumer protection agencies monitor the industry. If someone gets trapped in debt, the official story says it's unfortunate, but ultimately about personal choices, spending too much, not saving enough. Not reading terms carefully sounds reasonable, right? But if that story were true, then explain this. According to the Consumer Financial Protection Bureau, over 80% of payday loans are rolled over or renewed within 14 days. The average payday borrower, per Pew Charitable Trust's data, takes out 10 loans per year, paying $520 in fees to repeatedly borrow $375. If this system truly helped people bridge temporary gaps, why would the business model depend on repeat borrowing? Why would internal industry documents revealed in court cases show lenders specifically targeting financially vulnerable populations and designing products to maximize payment cycles rather than successful repayment? Let me show you what's actually happening behind the official story. This isn't about lending money, it's about engineering financial captivity, creating products specifically designed to ensure borrowers cannot escape. That every attempt to solve a financial problem creates a larger financial problem, and that the resulting wealth transfer from the financially vulnerable to financial institutions appears voluntary and beneficial. This isn't a bug in the system, it's the primary feature. The brilliance is that it makes victims blame themselves for outcomes that were mathematically guaranteed from the start. Here's exactly how wealth flows from struggling families to predatory lenders. Identify populations in financial distress using data analytics that map vulnerability, people rejected by traditional banks, facing unexpected expenses, living paycheck to paycheck. These aren't random targets, they're carefully selected hunting grounds. Offer products with terms that appear manageable short term, but are mathematically unsustainable long term. A payday loan at $15 per $100 borrowed sounds like 15%, manageable for an emergency. But that's 15% for 2 weeks, which compounds to 391% annually. Structure products so initial amounts can't realistically be repaid by due dates, necessitating rollover fees, renewals, or new loans to cover old ones. The CFPB documented that payday lenders design loan amounts and terms specifically to ensure most borrowers cannot afford full repayment, use psychological pressure and collection tactics to ensure continued extraction even when it devastates borrowers' financial stability. The threat of criminal prosecution for bounced checks keeps payments flowing. Securitize and scale. Package these payment streams into asset-backed securities sold to investors. Your monthly struggle becomes Wall Street's steady dividend. Who profits? Let's follow the money trail. At retail level, payday lenders generated over $9 billion in fees in 2020 alone. But the money doesn't stop there. These operations are backed by private equity firms and hedge funds providing capital and taking bulk returns. A 2014 New York Times investigation revealed major private equity firms, including Fortress Investment Group, were significant payday lending investors, earning 20 to 30% annual returns, not from productive activity, but from systematic fee extraction from desperate people. Think of it like a sophisticated mousetrap designed not to kill the mouse, but to extract value repeatedly, indefinitely. The cheese is real. You do get the money you need, but getting it ensures you'll be caught, and every struggle to escape tightens the mechanism. If you think predatory lending is new, look back to post-Civil War sharecropping. Formerly enslaved people were free, but had to borrow tools and seeds from landowners. Interest rates were rigged so at harvest time, workers always owed more than crops were worth. Debt bound them to land as effectively as chains. Early 20th century company stores in mining towns paid workers in scrip, currency only good at company stores with inflated prices. Workers borrowed against future labor just to eat, creating permanent indebtedness. The modern era has a specific birthday, 1978. The Supreme Court decided Marquette National Bank versus First of Omaha Corp., allowing banks to export home state interest rates to customers nationwide. Before this, states had usury laws capping interest around 10 to 12%. Suddenly, banks moved headquarters to states like South Dakota and Delaware, which gutted usury laws to attract business. This regulatory Big Bang allowed lenders to bypass local protections and charge 300%, 400%, even 700% interest legally. By the 1990s, payday lending exploded. In 1993, check into cash pioneered the modern model. By 2010, there were over 22,000 payday stores nationwide, more than McDonald's and Starbucks combined. Notice the pattern across eras, targeting vulnerable populations, exploiting legal loopholes, creating mathematically unrepayable debt structures using criminal enforcement mechanisms, and involving respectable institutions at arm's length. The labels change, the extraction math doesn't. Predatory lending exploits cognitive biases and emotional states to ensure compliance and prevent resistance. Behavioral economists have documented that financial stress drops functional IQ by up to 13 points, creating tunneling. You can only see immediate problems, not long-term costs. Lenders design contracts to be complex and approval to be instant, triggering present bias. Solving pain now regardless of pain later. They catch you when you're cognitively most vulnerable. They weaponize authority bias through official-looking storefronts and professional staff creating legitimacy impressions. Social proof works through neighborhood clustering. If everyone you know uses these services, they must be acceptable. Loss aversion gets triggered by framing loans not as debt-taking, but loss prevention. Don't lose your car. Don't lose your apartment. The scripted emotional journey, hope, you're approved when banks rejected you, to investment, providing personal information triggers sunk cost fallacy. To doubt, terms seem wrong but you're already invested. Relief, immediate crisis solved. Realization, can't repay without creating new crisis. Shame, feeling stupid for falling for it. Your hope makes you vulnerable to initial pitches. Your shame keeps you quiet after entrapment. Internal training documents from major lenders instruct employees to emphasize helping customers, reframing exploitation as service. Predatory lending thrives on atomization. Why don't people discuss payday loan traps? Because admitting debt cycles feels like personal failure. When you think you're alone, you don't organize resistance. You don't realize millions experience identical traps because each person hides it as individual flaw. This isolation prevents collective recognition of systemic patterns and political organization for reform. Scott Tucker, a race car driver, funded his lifestyle through a $3.5 billion payday lending empire called AMG Services. Federal trial documents revealed he set up sham businesses on tribal lands claiming sovereign immunity to bypass state laws. The smoking gun, internal documents showed loan repayment hierarchies were deliberately confusing. When borrowers thought they were paying off loans, fine print said they were only paying finance charges. Principal remained untouched. Tucker extracted billions before his 16-year prison sentence, but the model persists. In 2020, Santander Consumer USA paid $550 million settling allegations about subprime auto loans they knew borrowers couldn't afford. Why approve unpayable loans? They bundled toxic loans into bonds sold to Wall Street investors. Car dealerships got sales, banks got fees, investors got yields, and drivers lost cars plus thousands in debt. The system was designed to fail drivers to profit financiers. Wells Fargo admitted forcing unnecessary auto insurance on 570,000 customers, causing 20,000 wrongful repossessions. They automatically purchased force-placed collision insurance for borrowers allegedly lacking coverage, adding costs to loan balances. Internal audits revealed 80% of policies were unnecessary. Borrowers had adequate coverage. The bank was simultaneously lender, insurance seller, and commission recipient, creating direct incentives to force unnecessary insurance. They generated $73 million from the scheme, while costing borrowers over $200 million across the predatory lending ecosystem, payday loans, subprime auto loans, high-cost installments, rent-to-own agreements. Americans paid over $173 billion annually in fees and interest to alternative financial services, according to the Center for Financial Services Innovation. Let's break this down mathematically. Average payday, borrower fees equals $520 per year. Number of payday borrowers equals 12 million total payday fees equals 12 million times $520 equals 6.24 billion annually. Add subprime auto lending, where borrowers pay average 18% interest versus 4% for prime borrowers, a 14 percentage point markup generating approximately $35 billion in additional interest annually. Include high-cost installments, rent-to-own, and overdraft fees reaching that $173 billion total. That's equivalent to Hungary's GDP. It's equivalent to 3 million American workers' combined annual median wages. Over a decade, $1.73 trillion transferred from working poor to financial institutions and wealthy investors. This isn't just statistics. That $173 billion represents families choosing between rent and minimum payments, cars repossessed, degrees that never pay off, and neighborhoods stripped of spending power. The more this system extracts, the less capacity people have to build wealth. The less wealth they have, the more they need credit. This feedback loop isn't accidental. The revolving door between regulators and industry is documented. Mick Mulvaney, acting CFPB director 2017 to 2018, received over $60,000 in payday lender campaign contributions during his congressional tenure. Upon taking CFPB control, he dropped lawsuits against 4 payday lenders, shelved stricter regulations, and reassigned enforcement staff. He publicly stated he only met with lobbyists who contributed to campaigns, candid pay-to-play admission. According to Open Secrets, payday lending spent over $60 million on state lobbying 2010 to 2020, plus $15 million federal lobbying. The industry donates to Republicans opposing regulation and Democrats representing districts with payday operations, ensuring bipartisan protection. The Community Financial Services Association spends millions on PR campaigns framing payday loans as financial inclusion. They fund think tanks producing favorable research. A 2012 Huffington Post investigation revealed academic studies defending payday lending were industry-funded but failed to disclose conflicts. Major financial institutions profiting from predatory lending also purchased substantial media advertising, creating subtle pressure against investigative reporting. Think tanks like AEI and Cato, funded by financial services companies, produce expert testimony and policy papers opposing regulation. Payday lenders successfully lobbied for usury law exemptions in 37 states, explicit carve-outs written into law, often with language drafted by industry lobbyists. In Missouri, payday lenders can charge up to 75% interest on first $500 borrowed, effective annual rates exceeding 500% when fees included. Rent-a-bank schemes allow payday lenders to partner with state-chartered banks, evading state usury laws by claiming banks make loans, exporting lenient home state regulations nationwide. The Trump-era OCC issued guidance explicitly allowing these arrangements. Enforcement penalties are trivial compared to extracted profits. Wells Fargo's $1 billion settlement for force-placed insurance was less than one quarter's earnings, with no executive criminal charges and no admission of wrongdoing. Look for these red flags. Instant approval with fuzzy terms if marketing is simple but contracts complex. Ask who benefits from confusion. Focus on monthly payments while dodging total costs. Teaser rates with big back-end jumps, especially deferred interest charging retroactively if not paid by promotion end. Refinancing offers that reset clocks, lowering monthly payments while increasing total interest. Notice geographic clustering in stressed communities. Payday lenders, rent-to-own stores, and no-credit check auto lots concentrate in lower-income Black and brown neighborhoods. Targeted design, not random geography. Before considering high-cost loans, exhaust alternatives, contact local nonprofits, religious organizations, community assistance programs. Many employers offer emergency salary advances at no cost. Credit unions provide small dollar loans specifically as payday alternatives. Even credit card cash advances, while expensive, typically cost less than payday loans. If already trapped, contact nonprofit credit counseling agencies certified by the National Foundation for Credit Counseling. They provide free services, negotiate with lenders, and connect with emergency assistance. Some states allow extended payment plans for payday loans without additional fees. Historical examples prove reform is possible. Between 2006 to 2020, 18 states plus DC effectively banned payday lending by capping rates at 36%. Industry screamed the sky would fall, but residents adapted using credit cards, family loans, or expense adjustments, and were better off financially. Current pressure points: push for national 36% usury cap, support postal banking, allowing post office basic services, destroying payday business models, and build coalitions across ideological lines around the principle that no one should profit from trapping vulnerable people in debt. Build local knowledge and mutual aid networks. Talk openly about predatory lending. Share alternative information. Create informal lending circles, tandas or susus, where community members pool resources for interest-free loans. This model has existed for generations as predatory lending alternative. This system is one tentacle of larger wealth extraction patterns appearing in healthcare, medical debt traps, housing, rent extraction, mortgage servicing fees, education, student loan servitude, and employment, wage theft, algorithmic management. Each operates somewhat independently, but shares features targeting financial vulnerability, regulatory capture protection, complex structures obscuring extraction, and systematic upward wealth transfer. Understanding predatory lending provides analytical tools. Follow money, identify beneficiaries, examine incentive structures, recognize psychological manipulation, document scale, expose political protection, applicable to any extractive system. You're no longer a mark. You're an informed observer who can help others see what you now see. That awareness disrupts their business model and begins building collective power necessary to redesign these systems. Because here's the fundamental truth: systems designed by humans can be redesigned by humans. Predatory lending isn't natural law, it's policy choice, existing because it's been allowed and protected by those profiting from it. When enough people understand the mechanism, when the blueprint is exposed, when victims recognize they're not alone, that's when the system becomes vulnerable to change. And that change starts with you understanding exactly what you've learned. The art of the debt trap isn't about helping people in need. It's about engineering permanent extraction from those least able to afford it. And it only works as long as victims believe their captivity is their fault. You now know better. The shame was never yours to carry.